Hey, what's going on, everyone? So in this quick video, we're gonna be taking a look at a pretty common question. Is it better to pay off your debt entirely, or should you carry some level of debt while investing? Is there a better route to go? Should you push off investing until you pay off your debt? What's the best route with this? So let's cover that in this video. Let's just jump right into it. Pretty quick, pretty much to the point. So let's get into this video. All right, so let's start off with some of the pros of paying off your debt. What are some of the benefits of focusing on debt first, getting rid of it, and then moving on to investing or other types of various asset allocations that you want to deal with in the future? So the reason for paying off debt first, there's a really big reason for this, and that's the feeling of freedom, the feeling of liberation when you finally don't owe anybody anything at all. You're gonna feel really good about yourself. I know personally, when you carry a lot of debt, especially bad types of debt, we talked about good debt versus bad debt in previous videos, but when you're carrying a lot of different types of bad debt, like credit card debt or maybe car loans, it's definitely this feeling of sort of drowning in a sense, or suffocating when you have these monthly bills coming in month after month and you're owing interest on that, and it's definitely not a good feeling. We can all agree on that. So paying off your debt first, you're gonna get to that $0 mark where you don't owe anybody anything, and it's a really good feeling. Now, there's another benefit to paying off your debt first, and the reason for that is because it's more predictable. So what I mean by this is you know that maybe your interest rate is 6%, and it's probably locked in. Most loans are going to be locked in at a certain rate, and so 6% annually for the next 36 months. You know that if you pay $2,000 a month for the next 36 months, you know where you're going to be financially. Whereas if you're investing, you don't necessarily know where those investments are going to be next year. They might be up 40% and they might be down 30%. So you don't really know, and that is a benefit of paying off debt first. It is a little bit more predictable than investing, and I would put that as a benefit to it. Now, there are some downsides though to focusing so much on paying off your debts that you're not really thinking about investing. You're just paying off the mortgage and the student loans and the car loans and the credit card bills. And the downside of that is sometimes you can get so wrapped up in that you blink and all of a sudden you're 45 or you're 50 years old and you haven't even started investing. You don't even have a retirement account set up because you're just paying off your mortgage and your student loans and all kinds of different debts that you've built up over the past 30 years of your life or whatever. And so that could be a serious issue. And so you would probably want to set up something. There is a happy medium in between these two, and you want to do something like, personally, I would take advantage of my 401k plan. If your employer offers some type of retirement plan, definitely take advantage of that, or some type of stock ownership plan where they're matching your contributions of some sort. That's something you probably want to consider even while carrying some levels of debt. So I think setting up retirement accounts, almost regardless of how much debt you have, is important, at least in part important. You don't have to put tons of money into those retirement accounts if you're carrying large amounts of debt, but I think it is important to just get the ball rolling with investments. Now, there's really some benefits to focusing a lot on investing over paying off your debt. And one of the biggest benefits for doing that is this possibility of essentially making more money with your investments than you're paying with your debts. So what I mean by this is the goal here that most people have is to, say, make 20% in a year on their investments and have an interest rate for their average interest rate for all their debts, maybe 5%. So they're kind of a net positive there, and they're basically taking the earnings from their investments and paying off their debt with the earnings from their investments. But you got to be really careful with this, because you don't want to put yourself in a position where you're planning on paying off your debt with your investment earnings, because the problem that can occur here is that sometimes there's going to be external factors that affect your investments. And even the most intelligent investors of all time, Warren Buffett, Charlie Munger, Benjamin Graham, they have losing times. They have months where they lose, they have years where they lose, and just about everybody in 2008 going into 2009, a lot of people lost money. And so you could be an amazing investor, you could be a genius, but there's still going to be external factors that can affect you and your investments. And sometimes people don't always make the best decisions, and sometimes there's things that are out of your control that are going to negatively affect your investment portfolio. And the problem can occur when your investments start going down, when your investment account starts decreasing. Maybe it drops 10 or 20% in a matter of a couple months. Maybe we hit a recession or something else happens to the company that was unforeseen. So your investment account goes down and your debt is still piling up because you've been so focused on paying into your investment account that you haven't focused on your debt at all. You've been paying, say, your minimum payments for the past 20 years and you haven't really been worrying about them. And that's where you can sort of create this problem. And that's when people start to make irrational decisions. Now, I don't have statistics right here to show you this, but you can look this up on your own. I know that divorces, for example, one of the largest reasons that has been cited for divorces is monetary issues. There's a lot of problems in life where money is one of the root causes of issues. Maybe it's a personal problem, maybe it's a problem within a company, but there's a lot of different things that can be stemmed back to money or traced back to money, at least in part. So you don't want to put yourself in that position where suddenly you personally are stressed out because you're losing money in your investments and your debt's building up. So I think there's a happy medium here, sort of to summarize this video. I think there's really a happy medium here onto which types of debt you can carry while also simultaneously investing. So kind of a rule of thumb that I like to go for is really any debt that is above 5 or 6 or 7%. You can kind of set your own number on this, but for myself, it's usually about 5 or 6%, just because I really don't like carrying large amounts of bad or unnecessary debt. So anything above 5 or 6%, I will generally pay off right away before investing too much money. Now, if you carry some level of debt where it's a 2.5% interest rate from the federal government for student loans from 2011 when rates were really low, you know, that probably doesn't matter too much because it's a 2.5% rate that's almost free money. You could probably carry a balance on that for a little bit while maybe you invest, and you could probably pay that off pretty quickly that way. Now, if you're carrying credit card debt, anything in the double digits, you want to pay that off almost immediately. Get rid of that almost before you start investing. I would say, especially credit card debt, you need to absolutely get rid of credit card debt before you even consider investing. And that even goes for retirement accounts. Before you even start your retirement accounts, just squash your credit card debt. Anything in the double digits, get rid of it. So that's sort of my consensus on this. Obviously, you can tweak this to your own goals and needs, but I think it's kind of a good rule of thumb to go for because generally speaking, we see the markets grow about 7 to 10% per year. So you could kind of set it at that as well. You could say if you have any interest rates that are upwards of 7 or 8 or 9 or 10%, then you pay those off first, and then anything less than that you don't worry about as much. But personally, if you're like me, play it a lot safer at around 5% is kind of the cutoff where I decide if I'm going to focus on paying off that debt right away, or if it's a student loan at 3% that you don't have to worry about immediately and you can pay that off over time, but not have too much concern over. So that is this video. Hopefully that kind of answered your question, but if you have more, leave them down below. I'm always looking forward to talking to everybody on this channel. So thanks for watching, and I will see you guys next time.